Hello, traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to be talking about trend continuation candlestick patterns, which is one of the most reliable ways to identify when a market trend is likely to resume after a brief pause. If you've ever struggled with knowing when to stay in a trade or how to confirm that the trend will continue, this video is for you. Stay with me until the end as I will break down what these patterns are and how you can use them to refine your entries and exits for better results. So without wasting much of your time, let's get started. So let's start with the definition of trend continuation candlestick patterns. So these are essential tools for traders looking to align their decisions with the prevailing market momentum. This pattern formed during a pause in a trend and signal that the price is likely to continue moving in the same direction. And of course, understanding this pattern can help you make more confident decisions by confirming the strength of the current trend. So continuation patterns are specific candlestick formations that indicate a temporary pause in price movement followed by a resumption of the dominant trend. For example, you can see this bullish trend right here. So continuation patterns are patterns that we can see in areas like this that shows us that the price may be looking to continue in its initial trend. You can also see it in areas like this one. Some patterns right here are continuation patterns. I'm just gonna zoom in. They occur in a trend and they indicate that the trend is likely to continue in that direction. So what are examples of trend continuation candlestick patterns? Let's get started into some examples of key trend continuation candlestick patterns we have. So I'm going to start with the rising three methods and the falling three methods. So the rising three methods is a bullish candlestick pattern and it can be used for trend continuation. It starts with a long bullish candle followed by three smaller bearish candles that remain within the range of the first candle. The pattern ends with another long bullish candle that closes above the first candle's high, indicating continued bullish momentum. So this is the rising three methods candlestick pattern. And for the bearish counterpart, we have the falling three methods. And it begins with a long bearish candle followed by three small bullish candles contained within the first candle's range, and the pattern is complete with another strong bearish candle breaking below the first candle's low. So this should break below the first candle's low right here. So this is your falling three methods. So let's quickly look at one or two examples of where we were able to use the rising three methods and the falling three methods to enter some trend continuation trades. For example, you can see in this example, the first step when looking for continuation candlestick patterns is to look at the overall market context and do some technical analysis and some price action. Look at the market and identify the trend, the overall trend. Are we bullish or are we bearish? In this case, we are looking for bullish trend continuation candlestick patterns, so we should be looking at a bullish trend, and you can see a clear bullish trend right here. It is very clear, and looking at that, you can see this resistance turned support right here. So it shows that yes, indeed we are indeed bullish. This is a major key level right here, and you see price retesting this key level, and so we are looking to push price upwards to break structure right here. So in the process, we were able to see this rising three methods right here, indicating that this bullish trend may likely continue. We had the first bullish candle, three small bearish candles, all within the range of the first candle. Then we have the fourth candle breaking above, sorry, the fifth candle breaking above the first candle's high, indicating a continued bullish trend and showing that we could enter a trade at the close of this
with your stop losses below the low of the three candles, and you could target a 1:2 or a 1:3 risk to reward ratio, or you could just target significant resistance levels. So this is just one example of the rising three methods being used for trend continuation. Now I'm gonna try to look for another one, and you can see this candlestick patterns right here. The first thing is to look back and check if we are in a bullish or bearish trend. In this case, we are in a bearish trend, and you can see price giving us a bearish price action, and we are expecting to continue pushing downwards. So why should we take this trade? Now, if you are a swing trader who is looking at this zone, this key level right here, there, we take trades from key levels, key support, key resistance levels. So if you look at this level right here, there is a key level right here. If you extend it to the right, you can see price is at support, and we should be looking to take buy entries from here. Okay, price actually came back later to tap into that key level right here. So we should be looking to take buy trades from here. So if you're a swing trader looking to continue this trade from here, you could be considering this rising three methods forming here, and looking to take entries from any of these candlestick patterns. But if you are a day trader or a position trader, you could just forget about this, as we are currently in a bearish trend and you wouldn't want to be trading against the trend. So that is for the rising three methods. And if we look at the falling three methods, is basically the same thing. Here you can see the first thing is to identify the trend, and you can see that we are bearish, breaking structures to the lower side, and we should expect a continuation. And you can see this gap right here. Is expected price should fill in that gap and give us a push to the downside. And you see this nice reaction from that gap, and we started giving the push to the downside, and we had the falling three methods right here, showing us the first bearish candle, three bullish candles contained within the range of the first candle, and the fifth candle breaking below the first candle's low, actually gapped below it. And you could just be looking to take a short-term trade. You could go to lower time frames and look to take short positions to capitalize on this trade. So that is how you can use the rising three methods and the falling three methods as trend continuation candlestick patterns. Let's look at one more example of trend continuation candlestick patterns. We actually have a whole lot of them out there, but I'm just going to give you 2 or 3 examples. And the next on my list is the separating lines. So we have the bullish separating lines and the bearish separating lines. So the bullish separating lines involves 2 candles. The first is a bearish. This is for the bullish. This is for the bullish separating lines. And this is for the bearish. This right here. So for the bullish separating lines candlestick pattern, the first candle is a bearish candle followed by a bullish candle that opens at exactly the same level as the first candle. It may not be exactly, but it should be close to the same level as the first candle's open, but it should move higher, closing above the first candle's high. So that is how you should identify the that's how we should identify the separating lines, the bullish separating lines. And for the bearish separating lines, it mirrors the image of the bullish separating lines, showing a bullish candle followed by a bearish candle opening at similar levels but closing significantly lower, confirming selling pressure. Let's quickly look at the charts to find examples. Now you can see for the bullish separating lines, you can see this wonderful example we have right here. Excuse me. So we have the first candle, which is a bearish candle followed by a bullish candle right here. But before we do that, we should first look at the overall trend. We have a bullish trend. Remember, the first step is identifying the trend. We have a bullish trend right here, and we just had the fourth bounce of this trend line, and we should be looking for a push to the upside. And as we are analyzing, you can see this, the bullish separating lines forming right here, and we should be looking to take bullish trades at the close of the second candle. And you can see right here we have the first candle, which is a bearish candle, and we have the second candle, which is a bullish candle, and we should be looking to take a buy trade from there with your stop losses below the pattern. Remember, we should be bullish. You should also use volume to confirm your trades. You can see increasing buying volume at the time we had that candlestick pattern, so it's essential. And you can see here you could just take a buy trade, or you could just scale to lower time frames if you're a day trader, and look to take your buying trades from there. And you could target you can target resistance levels like this one, or you could just target fixed risk to reward ratio like the 1:2 or the 1:3. So let's look for the bearish separating lines example. We have one right here. And first we should identify the overall trend. In this case, we are in a bearish trend right here actually, and we have the third bounce of this trend line, and we should be looking for a bearish continuation to break structure to the downside. Now we have an immediate bearish trend line also, and this is the third bounce. We have the first bounce here, the second bounce, and the third bounce. Now, after looking at all these confluences and confirmations, we can now look at our candlestick pattern, which is the bearish separating lines candlestick pattern. We have the first candle, which is the bullish candle, and we have the second candle, which is the bearish candle, and it opens at the nearly exactly the same level as the open of the first candle, as you can see right here. So that is an indication to enter a sell trade. So you could scale to lower time frames, or you could just enter if you are a swing trader and your stop loss should be above the trend line or above the pattern in this case. And you could just target this support level, or you could target fixed risk to reward ratio like the 1:2 or the 1:3 risk to reward ratio. So that's how we're able to enter this trade. This is for a bearish trade actually. And that's how you can use the separating lines. We have another example here. We switch to a bullish trend, and you can see we have the first bounce, the second bounce, and we should be looking for the third bounce right here. And price gave us the third bounce, and we have the confirmation as a bullish separating lines candlestick pattern. You can see price opening, the first candle opening right here, and the second candle opening, which is a bullish candle, opening at nearly the same level as the first candle. So this is a bullish trend continuation candlestick pattern. You could just enter your trade here with stop losses below this area, and you could target a 1:2 or a 1:3 risk to reward ratio. And let's look at the third and final trend continuation candlestick pattern. So let's just make it 3. So we have this right here. This is the side by side white lines. This is a bullish candlestick pattern that consists of 2 consecutive bullish candles of similar size that open and close at nearly identical levels with a gap up from the previous price action. Now, these parallel candles show strong buying pressure, maintaining control of the market. So this is it right here. We have these 2 bullish candles of similar size that open and close at nearly identical levels. For the side-by-side black lines, which is the bearish counterpart of the side-by-side white lines, we have 2 consecutive bearish candles of similar size that open and close at nearly identical levels with a gap down from previous price action. The parallel formation of these candles indicates persistent selling pressure. Let's quickly look at some examples. Let's quickly look at some examples of the side-by-side white lines, and you can see this example we have here. First, remember the first thing is to look at the current trend. We are bullish currently, and we should be looking for buys. If you look at this area, this is an area of support right here. This is a key level, and we should be looking to buy from this area. So we already have the bullish trend line forming, and we have our side by side white lines right here. We have the first candle and we have this gap and a series of candles, similar identical candles right here, showing persistent buying pressure, and it means that the buyers are maintaining control of the market. So we just enter at the close of the third candle, confirming the trend, and stop losses below the overall pattern, the low of the first candle, and your take profits could be at significant resistance levels, or you could just target a fixed risk to reward ratio of 1:2 or 1:3 right here. So let's look at the bearish examples, and we have just one right here, and you can see the first candle. First of all, you can see that we are bearish. Remember to identify the trend first. We are bearish right here. We've had several touches at this area, and this is another confirmation right here. This is followed by a bearish engulfing candlestick pattern, which is a key reversal candlestick pattern right here, a bearish reversal candlestick pattern. So looking at the trend continuation candlestick pattern we are talking about, which is the side by side black lines, we are looking to continue the trend to break structure right here. And you can see the first candle, which is the bearish candle, followed by a gap and two identical bearish candles right here, and we should be looking to enter our trades at the close of the next candle after the pattern. Stop losses above the high of the first candle, and I'll take profits at fixed risk to reward ratio like 1:2 or a 1:3 risk to reward ratio. Remember, the first step is identifying the trend, then the next step is looking for additional confluences from price action. It could be additional candlestick patterns, it could be additional technical indicators like your volume, your moving average, your RSI, to confirm your trend and confirm the probability of taking the bearish trade. And also you should try to spot a very valid trend continuation candlestick pattern before entering your trades. Remember, risk management is very vital, and you should always set your stop loss and take profits at the appropriate levels. Sorry traders, you've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.